It truly never ceases to amaze me how much people hate the IRS and how much people hate paying taxes. And rightfully so. Truthfully, the government has done a wonderful job of showing how poor of money managers they actually are, getting us to nearly $37 trillion in debt here in 2025. So if you are a taxpayer in America, you do have the right to maybe have some frustration and outrage with the IRS constantly taking more and more money from you depending on how much you make. In this video in particular, I'm going to give you 5 myths when it comes to tax planning, because there are a lot of misconceptions about what you can and cannot do. So I'm going to share 5 of the most common that I see working with clients. But do keep in mind, all this is just for information, not for tax, legal, financial advice, or recommendations. Always speak with an advisor, right? So let's get into it. So the first is getting a big tax refund is a win for you. And this is one that commonly goes around. You'll hear a lot of advisors talk about this. Really all a refund represents to you as the United States taxpayer is a loan that you provided to the government to hold in the meantime, right? You're just getting a refund of your own money. And I didn't bring you to this video to explain to you what a refund is, but the problem with allowing the government to hold your money within that, 6, 9, 12 months, however long they've been holding it for, means that you weren't able to use it. You weren't able to invest it. You weren't able to pay groceries with it, right? You can't do anything with it. So refunds in reality just expose some withholding issues. Withholdings, whether you're a business owner, whether you are just a normal everyday employee, withholdings are the amount that are withheld from your payments. They are normally going to be paid to the government either on a bi-weekly basis with your paycheck, or if you're a business owner, you have to pay them quarterly. This is just the amount that they want you to cover sort of on an ongoing basis, right? They don't want you to pay in a lump sum one time at the end of the year. And if you are paying more on that normal basis, whatever your basis is, that is when you have an excess and you're going to get this refund. But if you are someone that has received a refund before, be sure to check with your employer, or if you're a business owner with your CPA, you're going to specifically want to check your form W-4. If you're at an employer, this will tell you how much they're withholding. But again, if you can get to 0, if you can get as close to 0 refund, 0 due at the end of the year, you'd be in better shape. One of the second things that I always hear is I have to itemize in order to lower my taxable income. Now, let me quickly explain the difference between itemizing and taking a standard deduction without boring the daylights out of you. About 90% of you are probably taking the standard deduction in 2025 and probably even more so next year, simply because they continue to make the standard deduction larger and larger. Now, all the standard deduction is that the government allows you at the end of the year to write off a certain amount directly from your income. So let's say, for instance, you and your wife made $200,000 this year combined. At the end of the year, at 2025, when you go to file your taxes next April, they're going to say, okay, you're filing as a couple, so we're going to allow you to reduce that amount by $30,000, however much you're making. In the example, I said $200,000, so in this instance, your taxable income would go down to $170,000 before applying your tax rates to it. Now, itemized works very similarly, but instead of getting a package deal from the IRS, right, $30,000 flat, they allow you to add up enough deductions that you could potentially take to make above that $30,000, right? So I'm not going to list off all the things that you can itemize here. There's plenty of things out there, especially if you're someone that donates, if you own a house, right? There's a lot of ways to potentially itemize your deductions. But what I want to talk about with this specific myth is that you have to itemize in order to lower your taxable income. Now, that's not true, because there are above the line deductions. For this video, you don't need to understand the difference of what above the line versus below the line means. But simply speaking, you can make an adjustment. You can lower your income without being someone that itemizes. You can still take the standard deduction and at the same time lower your income. And there's some specific ways to do this. The 3 categories that I'll just briefly mention to you are retirement, education, and health, okay? Retirement, education, and health. That's normally the 3 ways that you can lower your income for the year without having to be someone that itemizes your deductions. You can make a contribution to your health savings account, again, at your employer, or if you're someone that has student loans, right now you can take up to above, I believe it's $2,500 per year off your income. There's a lot of things that you have the opportunity to lower your income by, even if you just take the standard deduction, that I think it's important that you know about. 3 is I make too much to contribute to a Roth IRA. You can make an after-tax contribution into your traditional IRA, meaning the money has already been taxed, it goes into your traditional IRA, you don't take a deduction on it, and then you can immediately move it over into a Roth IRA at the same amount that you could with the traditional IRA. So I know I said a lot there. If you are not someone that is familiar with IRA terms, which are very boring, just know that if you have the ability or if you want to open a Roth IRA, you can still do so even if you're over the income threshold for the year that you're watching this, right? It's called a backdoor Roth IRA, and it is entirely legal as long as you do it correctly. The only caveat I normally add is if you do have other pre-tax money in a traditional IRA that has not been taxed yet, you're not going to want to do this. You're going to want to speak with a CPA or a financial advisor prior to doing that. I actually have another video on that I say watch. As far as write-offs are free money, or write-offs are the greatest thing in the world. And depending on your income, write-offs or a deduction is the actual word for that, can be very helpful, but again, it's going to depend on your income. Now, let me give you a quick example here. Let's say I was going to give you a $1,000 write-off. It does sound pretty substantial. Let's even say $10,000. We'll make it bigger for you. $2,400 if you are in the 24% tax bracket is what you're actually going to be able to save on taxes from that, right? So just a percentage is going to be saved with a deduction. Now this is different from a tax credit. Tax credit is much more like a gift card where it's going to dollar for dollar take away from your taxes. And without getting too far into it, all I want you to think about is a deduction or a write-off is going to be similar to a discount. We'll say a discount at a restaurant compared to a credit card at a restaurant. Let's say you go to your favorite burger shop and they say you get 15% off and you spend $100, right? So therefore you've saved $15. Or we can compare that to a gift card where you spend $100 and then you give the guy a $50 gift card. $50 is going to be your reduction here, right? So that's going to be a similar comparison with a credit versus a deduction. But always keep in mind that deductions are not as simple as a dollar for dollar write-off. One more thing before I move on to the final one here. If you are a business owner, if you are a 1099, please, I guess I can't give advice or whatever you want to call it, but be mindful of taking on an expense simply for the tax write-off, right? If you have to spend the money in order to do something or save on taxes, you still have to spend the money, right? Another example for this is if you're just a normal person, it'd be like opening a credit card just for the bonus that they give you, right? The benefit of opening something should not be something you're receiving in return, right? It should be because you already want to open that, right? So I know there's a million ideas out there for these fancy write-offs and deductions, but in reality, a lot of them, or a few of them, are actually going to make sense. The final one, and probably the most important and fantastic stellar job on strategy on my part of saving the best one for last, probably when the least amount of viewers are still here, and that is I make too much income to do tax planning, right? The same client I mentioned earlier, he makes $800,000 a year. And when we came to tax planning, it was, yeah, I know I send a lot of money in, but let's just move on, right? So that was part, he's just so disgusted he doesn't want to talk about it. But two, he doesn't know that he has so many opportunities in front of him in order to either one, legally avoid paying certain taxes, and two, take deductions that he otherwise didn't know he could have. So let me start with some avoidance of taxes, right? So there's a couple of taxes that unfortunately you as the entrepreneur or you as the high earning individual have the benefit of paying because you make a lot of money. The first that I'll point out here is the net investment income tax. Really all that this is a 3.8% extra tax that you have to pay anytime that you make above, I think it's 200,000 or 250,000, of course how you file, on top of your capital gains, right? So if you have an investment for $10, it goes up to $20. You know that you owe tax, if it's a taxable account, on that $10 of profit, right? Well, if you are fortunate enough to make above one of those thresholds that I mentioned, not only do you have to pay the normal tax on it, you have to pay this extra 3.8% tax, right? So being able to factor that into your planning is important to avoid things like that. Other important factors, of course, when we talk about what you might make, kind of leading you into a higher tax bracket, is alternative minimum tax. If you are someone that is a technology professional, if you're someone that has a lot of gains, or if you have a lot of wealth growth without actually having a lot of income, you probably know what I'm talking about if that speaks to you. You might be subject to alternative minimum tax. Gonna bore the tears out of you if I explain that one. Or for qualified business income deductions, right? If you are a business owner, you can technically write off 20% of your income from your business, assuming that you make below a certain amount and assuming you're the right business. So just being able to avoid these hurdles that the IRS strategically places in front of you, right? Being able to legally avoid taxes is very important. Okay, and that's more on the defensive. Let me quickly finish here with some offensive things that I normally talk about. The first is simply doing Roth conversions, being able to take a pre-tax asset, turn it into a post-tax asset with the goal of having high growth in that account and have it be tax-free in retirement. Having a plan to harvest losses in your investment account, right? Being able to take advantage of any of the losers I have in my portfolio, sell winners that I have in my portfolio, and have them net or cancel each other out so that I'm able to liquidate cash, but at the same time not have to pay taxes because of it. And then finally, if you are someone that is charitably minded, a lot of business owners and a lot of higher income individuals we work with, of course, do love to give back to charities or people that they care about, making sure that you don't trip any tax wires whenever you're gifting or whenever you're making a donation. Because yes, the IRS even has very stringent rules around giving. It's all very frustrating, but being able to help with that, right? So if you are someone that is charitably minded, there are ways to not only not have the charity pay the tax, not have yourself pay the tax, but you can also take a deduction depending on the donation. So it's always something important to consider. Okay, so if you're still with me, thank you so much for watching this video. I know I threw a lot at you and I know it's taxes, so definitely not a great recipe there. If you have any questions, please feel free to reach out to me. My information is in details. But thank you so much and I'll see you next time.